biggest trading range of the year, and this market has just done it. Now look at the New Zealand dollar here. Hi, it's Charlie giving you Wednesday's video here. We've on inflation day, it was CPI figures out of the US. And so what I want to cover through in this short video today for you is just a little bit about the reactions to this the CPI print, but more importantly is prior to today, if we take this back just to yesterday's price action, and not just looking at the New Zealand dollar here, but looking at some of the other markets as well. I want to talk about some mindset type issues that you can have at certain times as we go through the year. So first and foremost, yes, the Kiwi looks like, I'm eyeballing it, looks like it pretty much is the biggest range day of the year. That looked like a pretty big range there, but going all the way back, as we can see, to the beginning of the year, it's a whopper of a day here for the New Zealand dollar. But a lot of the markets have had some pretty good ranges today. The Aussie also has had a very, very good range as well, as you can see right up there with some of the biggest ranges of its year as well. So what happened today? The inflation figures, as most of you are already aware, they came in weaker than expected. So month on month came in at 0 month on month, which brought the annualized reading down to, oh god, now I think it was forecast to be 8.7. I think it came in at 8.5 or 8.6, something like that. 8.5, I think it was. So and this is what the market, more importantly, this is what the market's been looking for. The market has been looking for, are we at peak inflation? Have we reached peak inflation? And any sniff of that potential, and the market is going to run with that. So what's happened is that bond yields have fallen as as markets start to reprice future interest rate cycle highs going into next year. So the market's starting to reprice where interest rates go, and therefore bond yields start falling. And on the back of that, the dollar retreats, and so we've seen the Aussie having a cracker here as well against the dollar, and we've seen the stock markets rally on the back of this as well. So overall, that's what we're seeing, even down to the likes of the pound dollar and the euro dollar as well. Everything's rallying here today. So that's all good, and the stock markets are up and all of that as well. But let's now take us back here to on the likes of the pound, but possibly because going into today, we weren't really getting far over the last couple of weeks. We'd come up to here, we'd penetrated a little bit higher, then pull back, and we're overall over the last 2 weeks nothing too much going on. And it's probably a better example of that is if we look at the euro dollar here. We could look at, there's been times as well in the cryptos space where we've been seeing some flat times, and I think that this is more important than the move that we've had today. Is I think as traders you have to accept that there's going to be times in the year, going through any year, where there's going to be periods when the markets you trade, whether you trade the euro dollar or whatever you trade, doesn't matter what your market is of choice that you trade, there's going to be times in the year whereby that market is going sideways, like down here. And what you've got to be very, very careful of is becoming a strategy jumper, a time frame jumper, a boredom jumper in general, really. Because if you say, oh, the markets are boring, I've got to be finding a way to make money, that's the wrong attitude. Because what you're then doing is you're putting your stamp onto the markets. You're effectively saying, I need to make money from the markets, I need to find a way. That's not the way to do it. Trust me on this, it's not the way to do it. The way to do it is to carry on with your proven method, carry on with your proven approach, and put up with the fact that there will be periods whereby your chosen markets that you trade, or the strategy that you trade with, goes through a flat period where it's not really delivering anything from you. Don't become like those masses out there who as soon as they get bored from either a sideways market, or their strategy starts to just go sideways or underperform, they're already looking to jump. So they're like, oh, this is boring. Maybe I need to day trade. And so I'll come away from swing trading now, and I'll day trade, because then I'll be able to find some short-term moves within all this chop. Then at least I can still be making some money. It's the wrong sort of attitude to have, because all you're then going to do is probably, if you start jumping around, you're moving your style around too much, and it's likely you're going to be making mistakes. And so if you jump from strategy to strategy, you're going to be making mistakes. If you jump from time frame to time frame, if you're constantly jumping around, you're going to be making mistakes. So my best advice to give is actually write this down on a post-it note or into your phone or whatever. And it's acceptance. There's lots of things that we have to accept within the world of trading, and you could make a huge long list of all the things we have to accept. We have to accept we're not going to be right, for example, all of the time. We have to accept that for every 100 trades we do, a given percentage of those are going to be losers as well as the winners. We have to accept that we are going to get nicked out of trades when we're using stop losses, only to see price go in our direction as well. There's all sorts of things that we have to accept, but the better we become at accepting all of these different things, like accepting that through the year there will be times when the markets are boring, but if we can accept all of that in advance, then we don't start looking for new things when something like a boring sideways market does occur. Now, it could well be, if I just change my pen slightly here, it could still be that this is a one day wonder on these markets, and then they start to drift again as we are into August. But that's also a myth, because if you go back over the months of August, if I go back to last year, for example, yep, nice movement down, nice movement up. Nice, decent moving month there, price there. Let's go to the August before that. And that August in the euro dollar, yeah, choppy. Okay, moving, plenty of moves, but overall a bit choppy there. Let's go to the year before that. A nice move to the upside, bit of sideways, nice trend to the downside, and so on and so forth. It's a myth that August is going to be a boring month. It may impact on day traders more so than swing traders, because the ranges can get smaller, which is going to affect day traders. But overall, we always have to accept that that might happen in August, but it also could happen in the middle of October. The potential is always there. So just like when if I take the euro back to last year, in fact, look at that, in November and into December. And before people say, well, yeah, but December's Christmas time for half the world. Yeah, but you don't always see movement like that for 6 weeks or so. So boring periods in any given market can happen at any stage. So your job is to already be pre-prepared for all of these things, accepting all of these various different occurrences. And if you're better at accepting all of that, when the next opportunities do arrive, you're prepared for it. And in the meantime, if these markets were to flatten off and just carry on going sideways, well, that's okay too. But don't become one of those masses who wants to then jump from one thing to another, to another, to another. Stick with your processes and the markets will come to you. Hopefully that's of some use to you today. I shall be back with you on Saturday.